I want you to think back to 2022. The market was down 18%, inflation was high, and for many people nearing retirement, it felt like a disaster. But look what happened next. Since that dip, the market has gone on a tear, delivering back-to-back years of returns of around 25%, followed by another 17% in 2025. Feels great, but there's a catch. That kind of winning streak can quickly distort our expectations. And here's some things I want you to remember. Historically, the S&P 500 returns about 10 to 11% per year, but the path is bumpy. That average includes wars, crashes, bubbles, and pandemics. It's never really a smooth line. It's also important to remember that stretches where the market grows close to 20% or more for 3 straight years is pretty rare. It's only happened 5 times since 1992. When things are this good for this long, we start to think it's normal. But for someone about to retire, building a plan based on these best case scenarios is a dangerous gamble. I'm Nick with Networth Advisors. Today I'm going to talk to you about the sequence of returns risk and why the rules change at retirement. So most of us are taught early on that if the market averages 10% for 30 years, we'll be fine. While you're working adding money to your accounts, that's mostly true. But the moment you stop adding money and start withdrawing it for income, the math changes completely. This is called, again, the sequence of returns risk. In retirement, you aren't just facing market volatility, you're facing the volatility combined with withdrawals. If the market drops early in your retirement and you still take your monthly check, you're forced to sell stocks at low prices. This permanently reduces your base. When the market eventually recovers, you have less money left to grow back. Simply put, early losses in retirement aren't just temporary setbacks, they can be permanent damage to your lifestyle. I want you to consider 2 different retirees in this scenario. To illustrate this, let's take a look at 2 people. They both have $1 million in retirement savings. They both withdraw $40,000 a year, which is consistent with the 4% rule we all know of. And they're both invested in the S&P 500 index. The only difference is when they retired. So Retiree A, they retired in January 2000, right before the dot-com crash and the 2008 financial crisis a few years later. Even though the market had good years later on, those early losses were devastating. Retiree A's ending balance after 10 years was $500 or around $515,000. Retiree B, on the other hand, they retired in January 2014, which is right before we saw a massive bull market run. Those strong early gains built a buffer that protected them from later dips. Their ending balance after those 10 years was $3 million. We're looking at the same index, same withdrawals, but a $2.5 million difference in results. This is the power and the danger of the sequence or the order of your returns. Most retirement plans don't fail at the end of life, they fail because of what happened at the beginning. You can't control the market, but you can't control your design. Relying on long-term averages or assuming the market always recovers doesn't work when you have bills to pay or a lifestyle to live. So what's the takeaway? You can enjoy the current market run, but I wouldn't build your future on the assumption that it's going to last forever. Successful retirement isn't about predicting the next crash. It's about building a structure through liquidity planning, smart withdrawal rules, and robust and sound portfolio management. These things combined can help you survive a crash if it happens early. When you plan for the worst case early on, your retirement becomes a lot quieter and a lot more secure. I want you to take a look at your plan today. Is it built on averages, or is it built to survive the sequence? Again, I'm Nick with Networth Advisors. Thank you for taking the time to watching, and we'll see you soon.